but the prep. Oh, we're live. Hi.
Ah,
No,
well,
that's what makes these things great is that there is no prep
no
and it's
prep.
just
Yeah.
a conversation because nobody wants, man, nobody wants scripted crud. Like it's not authentic. It's not fun. It's nothing. So right now I'm just spinning dead air. So that's cool, right?
Yeah, it's zero anything to talk about. So I'll
That's
tell
it.
you, I've really wanted to do a video on how you can buy a home for nothing, for $0. For
So not like not the investor side of it, like using
no,
somebody else's
no,
money,
no,
but
no,
just
no.
you
I don't
doing it with
mean
zero
I don't mean
dollars.
you being a landlord. No, I'm not talking about that at all. But
Okay.
if you are especially if you're a first time home buyer, but even if you're not, there's ways for you to get up to 5 to 6.5 right now. It used to be 7% of the loan amount, and just given to you at closing. You do have to meet certain criteria. You can't make too much money for those programs, but
Okay.
you can let the sellers pay for a little bit more,
Yeah.
about 3% in that case. And I had a VA guy I put into a house last year, um, and we gave him $3,300 back at closing.
That's
Do you know
awesome.
that VA loans have this weird thing where you can pay off the VA's debts? Not the VA, but the borrowers, the veterans' debts.
I did not know that. That's
Sellers
pretty
can
crazy.
pay, they can pay off certain debts for the VA, for the veteran, that will then allow them to buy the house that was prohibiting them to do so beforehand.
All right, so we are going to end up with a ton of content that we can do, but I'm going to go ahead and get us started because now we've got some people watching.
Oh,
Guys,
sweet.
good morning. Saturday morning, September 26th. I'm Chris Beshek, Dripping Springs Home Team, sitting here with a good buddy of mine, Stephen Babcock at Benchmark Mortgage. Stephen's a mortgage lender. If you're popping on, if you saw my post yesterday, we're going to talk about a very specific question that I got from a good friend of mine, and let's go ahead and jump into that. So, Stephen, here's the question. She and her husband are doing what you're actually supposed to do, which is plan ahead to buy a house, and they're planning ahead, maybe a year, 2 years, making sure that their finances are in order, their debts and all of that stuff is taken care of,
Good. Yeah.
and so they're doing it the right way in my mind. And they had a little, I don't say it's an argument that they had, but her and her husband were discussing it. They had just paid off one of their credit cards, and I think they've got three total credit cards.
You don't want to do that, but yeah, keep going.
We'll get to that. They had three total credit cards, and they just paid off one. It was like a box store credit card that they paid off, and her husband were discussing kind of about should we close that credit card or should we leave it open. So from a lender. And you deal a lot with first-time home buyers and home buyer credit and stuff like that. So, what do you do as a home buyer if you're planning ahead and you're paying off some of your credit cards? What do you do with those credit cards?
Okay, the first thing I would say is to keep in mind, great question, by the way. Oh my God, great question. First thing I would keep in mind is that the credit system itself was not designed by a moral majority. It wasn't like made by the Catholic
Correct.
something, okay? This was made by corporations and they're going to get their money, all right? I find that if you pay off a credit card, I have a thing called a what if simulator as a lender. So I can take someone's credit score, look at all their debts, and then say, okay, well, what if I paid off the card to zero? What would that do for the credit score? And I'll get something, it's always different per person, right? But in the past, I've had examples where I've done about 30 to 40 credit points for paying off an entire like $10,000 credit card.
Okay.
I pay it down and leave a $10 balance. I get like 70 credit points. It's more than double. It's crazy sometimes. So the point there, remember I said it wasn't a moral majority, right, or a moral institution. They want you in pain. They
Yeah.
want you in pain. Otherwise, you're not making them any money, right?
That's
You
right.
have a little bit of interest that you're paying them. Otherwise, they're just wasting their time. But they don't want you in enough pain to be a threat. So my very first thing is never, ever pay off a card in full. Always leave about a $10 balance on it that carries over to the next month, right?
Okay, so let me hang on for 1 second on that. So if they're planning ahead, like a year ahead, do they still need to carry that $10 balance, or can they put $10 on it later?
So I know many, many, many people that have done the 800 plus credit score stuff, and almost all of them do the same thing.
Okay.
It's just a way of playing the credit score game, and it is a game. I'm
Yeah.
swearing it's so bad. I mean, my head gets itchy when I talk about it. So the other thing is, and this is what your original question was, I believe, was the closing down the credit card, right?
Yeah.
35% last I checked of your credit score is from credit history. So if you have a card that you've been making payments on time and you paid it off, you closing it down will most likely reduce your score, sometimes drastically. So no, you never ever pay off. I'm sorry, you always pay them off for down to 10, but you never ever close them down. Never ever close down a credit card ever.
And so I'm gonna draw a distinction because I know what you're saying. Never close it down if you're going to buy a house. Once you buy the house and you've got that part done,
No,
shut it
no,
down.
no. I would argue against that as well.
You would still keep it open
Yes, because it's going to hurt your score even if you buy the house. And who wants a lower score?
if you buy another one down the road.
Now, in the case that the card is costing you, $250 in an annual fee or something, fine,
Yeah.
Right. But other than that, because then it's still going to hurt your score, right? But then it's also hurting your pocketbook, right? So at the same time, it's going to people, right? But I mean, yeah, man, you just don't ever want to close down a card, ever. I've seen people come to me with a 600 credit score, and then they get mom and dad's 35-year-old credit card that they authorized user. They make them an authorized user on the card, right?
Yep.
Basically, mom and dad are saying, we want a credit card company. We want our kids to have a credit card. It's the same one as ours. Just put their name on it, and we'll pay off the bill, right?
Okay.
So mom and dad don't even actually have to give the credit card to the kid in that case. They'll get it in the mail. And, if they want to give it to the kid, great. Here's your emergency card. If you need gas or something, you're stuck in the middle of the whatever, great. A lot of parents do that. But I've seen people go from like a 600 to like a 780 credit score by being an authorized user on their mom and dad's card, because usually those
They've got the history
with great credit, but they don't have the history, so they don't have a great score. Right? And mom and dad had the history, and those kids have those. They don't have any missed payments, and it's all of a sudden it's like, oh yeah, these guys look great. We didn't know they had that trade line.
That is insane.
Again, it's not a moral company. The last thing I really, really, really want to drive home on credit scores. I'm sorry, I'm on a roll.
No. It's awesome. Get it.
Collections. You never, ever, ever, except for very rare instances, pay off a collection, because once your credit, once it gets hit with the collection, please follow me on this. The algorithm, which is all that the credit scores are, right?
Yeah.
Stops monitoring, caring, looking at all how much money you owe. You could owe $1 million or $1 billion on a collection. Once it hits collection status, right, then you just owe a collection. They don't care about the value. Okay.
Huh.
So what happens is the credit system registers an input of collection activity, right? So when you pay it off, it does nothing to your numbers, but it registers more collection activity. And you get hit again, just like you did the first time when you got hit with the collection.
Wow, I had no idea.
I cannot even tell you how many people will call me, and I don't want to say arrogant, but they know what they're doing, and how could I know?
Yeah.
Not like I help 50 people a year or anything like that. So maybe I'm a little bitter. But they'll come to me and they'll be like, listen, we're going to come see you in about a year. We just want to let you know, we want to apply, make sure our numbers are okay, but we don't want to meet with you or anything. And okay, and then I'll try and give them some advice. They just don't want to hear it. And then they come back to me in 2 years, and the score is even lower than it was then, because they've been paying off collections. And in their mind, it was like, no, I'm going to do the right thing. And quite frankly, that is the right thing, darn it.
It is. But again, it's the moral thing.
It should help, right? But it's not moral. Sorry, I interrupt. Yeah.
No, you're right, and that's what it goes back to. It's corporations. It's not moral. It's two different things.
Right. And then COVID made it even worse. COVID, we needed like a 580 credit score minimum to do a mortgage for somebody.
Yeah.
There's other factors besides a credit score, but we needed, that was the credit score requirement there. Today, it's right around 620, but realistically, it's really like 650, 640.
Wow.
And for a while there, it was up to 680. Like right after COVID hit, people with an under 680 credit score, we just weren't able to help. And it wasn't us, it was the investors on the back end that buy our loans. They were like, hey, we're not interested anymore. It's too risky.
That's nuts. I heard, because I've heard stories about like you said, there's loans that aren't being purchased anymore because of this. I heard a couple was having a hard time with qualification because she was in a service that had direct human to human contact.
Oh,
and
yeah.
the underwriters were actually looking at that and punishing them.
Oh, yeah. I had a bartender that was working with me, and we got this email from corporate that said, specifically, if you have anyone in the restaurant industry or a bartender, you can't. I'm like, oh, crap. That was about as I can't get any more specific than that, right? Like, sorry, bud.
And it's crazy that, that if somebody's looking for a loan, hey, you have a job and that job is held against you.
Right. Well, the worst is self-employed. When I've
Yeah.
that are
Hey,
self-employed in the first year. Yeah, hello. First year they're making, you know, 100, $200,000. You know, it just blows up, and they
right.
can buy a home to save their life. At least not with a traditional program. There's other called non-QM programs you can use, like a bank statement loan, but the rates are so bad that everybody, you know, like, oh great, let's get the house, and then I show them the rates, and they're like, oh,
Yeah.
here.
Let's wait another year. Let me get my history.
Yeah. So I mean, there's ways, but you know, you got to have a 2-year history in lending. So if you're going to be in a fluctuating kind of income,
hmm
we need a 2-year, you know, commissioned, 1099, self-employed, you know, partnership, whatever. We need 2 years. If you are anything that's set in stone, right? You're always 40 hours a week, or this is your salary. As long as you don't have a job gap. By the way, being in school is not a job gap. That we actually consider that like working. You know, so you could go right out of college, just buy your first home, as long as you have, you know, a salary position or a W-2, you know, position.
Let's get back a little bit to the paying off credit cards and all of that stuff. Um,
Oh, I forgot one
Anything
more.
else that just kind of pops into your head about that
Yeah,
topic?
yeah.
Yeah,
Good call. I was like, oh God, I forgot one more thing. Once you approach or pass 30% utilization of the card, so if your
that's what I was going to ask you about. I'm glad you're. Yep, there you go.
so if your card has $1,000 limit on it, right, and you spend $300, well, $301, your score is no longer being helped every month. Once you get to about 50% on that card, so you spent $500 on the card, your score starts dropping every month pretty fast. If you were to, I got a comment here and just totally distracted me. I'm so sorry.
Yep, there you go.
If you were to keep the card under 30%, the score goes up. So, all right, let me read this. So I just refinanced and was told the oil/gas industry employment is a negative for lenders. You know what? Yeah, it kind of is.
That's crazy.
Refinanced, so I'm guessing you got it through. It would depend on your position in the oil and gas. The real issue here is, you know, are you going to have a job next month? And things are getting a little more certain every day, right? But in the beginning, it was like, nope, no, anybody that could possibly qualify, forget it. We're not gonna look at them, right?
Yeah.
Me making this decision, it's, you know, it's people upstairs, right? But it's, you know, it was really, I mean, let's put it to you this way: when this thing first hit, my biggest pet peeve in lending is when people ask you what the rate is, because there's 42 different things that go into what rate you get. And it's not a rate, it's like a range of rates. And there is no rate that costs $0, that you can get all the rate you want to by paying money for it. Anyways, I've forgotten where I was going with this, Chris. I'm getting so distracted. What was the question? Just refinanced oil and gas.
Oh, negative for lenders. And you were talking about how the question is whether or not you're going to have a job. And then you went back to the beginning of coronavirus where everybody was freaking out about everything.
Thank you. Yeah.
Oh, you're good.
It's really just, it really just boils down to the investors, I guess, is really the ultimate point.
Yeah.
If they want to buy it, we'll sell it.
Yep.
That's it.
Nick's a former football player of mine. He and his brothers, and good family. Nick, I think Nick's an engineer in oil and gas. I'm pretty sure.
Yeah. 2.375 is a great rate too.
That's what I thought. That's
Yeah.
a pretty good deal right there. God, it had me thinking about something else real quick, and I can't remember what it was. Anyway, back to the 30% utilization.
I did the same thing. That's fine. That's great.
Oh, I'm sorry. Not an engineer. Nick is way smarter than I give him credit for. He is a geophysicist. So there you go. I think Nick's job is fairly safe in oil and gas fluctuations. I could be wrong, but anyway.
You know, it's one of those things where lenders can't be speculators, right? I mean,
Right.
we got electric cars coming out and the fusion cells and I mean, like, come on now. If we were speculators, we wouldn't lend to anybody, you know?
That's right.
And furthermore, at the end of the day, the government makes all the rules we have to follow, right? It's just really that simple. They make all the rules. They tell us what to do. We can make them harder. Those are called overlays.
Right.
You know, a 620 score is what you need. We'll do 680, right? Well, that would be an overlay. We're tougher, right? But, you know, we don't.
So, but before that, you were going down a little bit of a road with asking what the rate is, and so I'm going to take a little bit of a sidebar on that.
Yeah, please.
If you have the same person, okay, me, I want to buy a house, all right, and my credit score is fixed, my income is fixed, and all of that stuff is fixed. It is what it is. If I go to 10 different lenders and request quotes from 10 lenders, If they're all shooting me straight, not feeding me full of bullshit and telling me they're going to give me a 2% rate when that rate hasn't been seen in 8 months or ever, okay, if they're all shooting me straight, okay, what is going to be the difference in the rate that you can get me versus the 9 other lenders that I'm comparing you to?
How much they get paid? How's that for a quick answer? You know,
you know I set you up for that.
Oh, of course, it's fine. The reality is, if one lender has wildly higher rates than another lender, they don't stay in business very long. So,
Right.
And we're all tied in directly to the bond market, which fluctuates just like with the stock market every day, right? So you know, every 15 minutes I get new rates that I can choose from. You know, it's very frustrating for me, rates in general, though.
Every lender I know.
Let's put it to you this way: when coronavirus hit. I mean, it hit slowly over time, but when everybody acknowledged it and we did the first shutdown, right? There was a guy with an 800 credit score I was working with, and keep in mind, people shop lenders all the time, right? Just imagine how frustrating this would be for me. Okay, not to make this all about me, but this guy wants to lock in a loan, and coronavirus just hit, right? The things are crazy. The market is doing like this. I mean, it's like dive boarding, right? So, in the morning, I pulled a 5.125 for this guy. In the afternoon, I pulled a 3.625. Imagine if he'd been shopping me that day and just called another lender in the afternoon.
Yeah.
We have a much better rate at that point.
Right.
He'd be like, man, that guy Steve, I'm never giving him business, right? I mean,
Right, exactly. This guy's just trying to kill me with this stuff.
But to wrap your head around it, when things are fluctuating that wildly, entire companies go out of business overnight because of the insurance cost of just locking in the thousands of loans they had. And it was a perfect storm because the rates had never been lower at that point in history. And everybody and their mother and everybody, I mean, alien mothers wanted to refinance. You know what I mean?
Right. Yeah.
Refinancing. So they had so much stuff on the books. I mean, they had something like 2.7 times as much business in the first 3 months of this year than they did in the entirety of last year because of the rates as an industry.
Yeah.
And the coronavirus hit and made it so that almost all those companies had to hold on to at least half of those, maybe, those loans, right?
Right.
And if you couldn't afford it, I mean, a few companies have actually gone out of business as a result.
Yeah.
Already.
Real quick, and I'm going to I always forget to do this. You're supposed to do this about every 5 minutes when you're doing these, but I forget. Guys, just so y'all know, Steve Babcock's a good friend of mine with Benchmark Mortgage, and we're just kind of chatting about one specific question, but it's leading off on these tangents, which is always good. If you've got a specific mortgage question, even about refis or whatever, pop them into the comments. I'll make Steve answer it, and if he won't answer it, I'll make up an answer.
I love it. Well, no, you know what?
Good.
Let me tell you a story to answer your question a little better from the last one. I had these kids. Well, they were 24. They weren't kids. Whatever. I saw them as kids.
You're old. Yeah.
I'm old. I'm almost 30. I'm not 20. So, anyways, so I had these kids come to see me, and I swear to God, the only reason that they came to see me was that the realtor was like, "Hey, your rate is too low that you've been quoted. I think you should call my guy Steve. He'll at least tell you the truth, right? I promise." So, kind of had that reputation, right? At least I hope I do. So they come to see me, and they actually didn't want to talk to me. I mean, go figure, right? They had found their best rate, whatever, and they were kind of not super nice about it up front. And then they came in to meet with me, and it ended up being really, really good. But and they were great, very nice to me then. But after they met with me, we got to this part in my presentation where I pull rates right in front of you. I show you all the different boxes I got to fill in just to get you a rate, so like how crazy it is to call somebody and ask what the rate is.
Yep.
And then when I pull rates, I show you this list, and you can get paid money for taking a higher interest rate, and you can pay money to take a lower interest rate. Right. And that's not a down payment. That's a fee, right? That either helps you offset some of the closing costs or costs you more in closing costs. Right. So these people sit down in front of me. I get to this point in the presentation, and this guy's face drains. I mean, we just went white. And I'm like, "Do you have any paperwork from the other lender?" He's like, "Yeah, man." He brings it out and shows it to me. And on the 6th page, the guy was charging him $19,000 for their interest rate. Right. By the way, rates that I was pulling for them right there, the closest $0 rate that I could find was right around 4.75, and they were being quoted at 4.125. So I asked them, I said, but this is where rates were back then. And so I asked them, I said, "Hey, what questions did you ask the lenders when you were calling?" They're like, "Well, we called 9 or 10 lenders, and we just, what are your rates? I'm like, really? That's what you did, right? I was like, oh, it's my biggest pet peeve, right? And so because there's no way for me to give you a right answer without knowing the rest of your financials. So I'm lying to you by giving you an answer, right? That's why I can't stand the question. But anyways, bottom line is that guy had asked them 2 questions. Oh yeah, I'm happy to give you my rates. How much money do you have to spend, and what rates have you been quoted? So,
if you've got the money to spend, I got a place for you to spend it.
Look, the conclusion ultimate answer to your story is that there's a lot of things you can hide in the mortgage industry, right? You can't hide. And every few years they redo all our documents to make them more legible, which makes them even less legible.
Right. They don't make any sense.
I've never met someone in my life that understands APR. It just confuses the heck. But the bottom line is there's 2 things that can't be faked as a mortgage lender. One is the price you pay for the house every month, your monthly payment. And 2 is cash to close, the money you've got to bring to the closing table to get the keys, make it yours, right? The 2 numbers you can't fudge. And if those kids have been looking at that last number and compared it to mine, that would be almost $20,000 cheaper, right?
Right.
For like a $70 a month higher payment, something like that.
And it's
please put $20,000 in the stock market. It's low right now.
Yeah, right, exactly. And it's funny. It's funny you say that because I recently had a buyer who was looking at it was a new home construction, and her lender gave her an option of an FHA loan or a conventional loan, and it didn't click with me. But I'm looking at because she said, "What's that?"
Explain the differences.
No, not really. Just kind of gave her a fee worksheet for both.
Okay.
And she asked me, she goes, well, which one of these would you do? And I looked at the fee worksheet and I said, it's conventional loan all day long.
All day long. Yeah.
All day, because your cash to close is less. Even, I think the payment was almost identical. I can't remember the exact thing, but I was like, it's a conventional loan all day long. And she said, that's weird. I asked him and he told me that I should do the FHA. And I'm like, what the? I'm trying to figure out what the hell is going on.
So how much lower was the cost?
It wasn't. The FHA was more cash to close.
Yeah, but the monthly payment.
It was almost identical.
Oh, then yeah, stupid. So,
but here's what I didn't know. And keep in mind, this is a preferred lender for a builder. Okay. And so what wasn't ringing a bell for me, because this is what's not on those, and you answered it a while ago when you said, how much are they getting paid? So I was just having a candid conversation with another lender, and he goes, dude, you make way more money on an FHA loan. So this freaking lender was telling my client to take out an FHA loan, even though it was going to cost her about $3,000 or $4,000 more out of pocket to close the house, because he was going to make more money.
That's really awful.
I'll tell you what, if she hadn't asked me, she sent me the fee worksheets and asked me which one. If she hadn't done that, she would have ended up in an FHA loan and $4,000, $4,000 out of pocket. Hey, here's a good recommendation for you.
Hey, Amy. Amy, you have been amazing. Thank you very much. She's so supportive. She sends me people. She's awesome. I love Amy. You're awesome.
That's awesome. And they're loving that. They're loving that swimming pool. I know that. That's all she wanted. Amy, you would have lived in a friggin' like a 13-foot travel trailer as long as it had a swimming pool. Don't lie. I know you would have. She just wanted that swimming pool.
I love it. Well, I was going to say, God, thank you again, Amy. It was awesome. I was going to say that when I first got into the industry, I was told by my mentor at the time, because you got to have a mentor in this industry. It's so, yeah. But he was like, "Hey, don't ever do the down payment assistance stuff. You'll get crap borrowers. They run out of money in the programs, and then you're screwed. You just messed up the borrowers. It doesn't pay you as much anyways, and they're usually borrowers that don't qualify." And I'm like, okay. And then as I went throughout my life, you listen to your mentor, right? So then I started really doing loans for myself, and I had my own kid. And then I realized I missed out on like $11,500 on my own mortgage because I didn't add something called an MCC credit.
Yeah.
Which gives you a tax rebate at the end of the year, which I did qualify for as a first-time home buyer, which I now don't because I'm not a first-time home buyer. And nobody told me about it, right? I'm telling you, that's part of the reason I'm bald right now, right? So oh my God, I got so angry. So now I'm kind of specialized in doing it. and it doesn't pay me that much less. And the borrowers are usually better than the other ones because they're the ones that are doing the research. Like, hey, what do
Right.
I qualify for? It's great. I love it. So I hate that backwards attitude of just
It is. Well, and like you said, there
drives me
and
nuts.
what you're getting are the buyers and borrowers that are doing stuff a year in advance, trying to make sure they do it right,
Right.
like we're
Or you
talking
get
about
somebody
right
like
now.
Amy, who appreciates the fact that I looked into those programs
Yeah,
tells other people about me, and I can truly feel like I'm helping, right? I mean,
right, exactly.
going to bed happy every night,
And
right?
in case y'all don't know, I'll pop Amy back up here again. The reason she and Robbie, I think, qualify for some of that stuff. Amy's a school teacher, and so I think there was something that was also tied with school teachers, correct?
Yes and no. There
Okay.
was a school teacher program back then that I believe, if I remember correctly, Amy, you'd asked me to look into it, but it sucked compared to the one I found for you. So
Oh, okay.
yeah,
There you go.
I think if I'm remembering correctly.
But
Yeah, it's funny. The teacher programs, the same requirement for other programs, and most of them don't have very good interest rates. I don't quite understand that.
that is kind of interesting.
Can I share my screen with you? Am I allowed to
I don't
share?
know. Can you?
Sharing scripts tips. Sharing is easiest with two monitors. Well, I have three. Maybe I should just unplug my monitors and try this again.
If you go out.
Well, I don't have to. I don't have
Yeah,
to do
there
it.
you
It's fine. But bottom line is, right now, if you have a 620 credit score or higher, there's a down payment assistance program that will pay you 3% of the loan amount. Okay, so if you're buying a $100,000 home, which doesn't exist, right? But if it did, you'd be given $3,000, and the interest rate is a 2.875
Whoa,
with a 620 credit score.
that's crazy.
You want to go conventional? You need a 640 credit score. Now we're looking at a 3.125 if you're making less than $78,080 a year. Or you'd be looking at a 3.5 if you're making,
Combined household?
yes, if you're making
Okay.
less than $97,600 a year. Now, it's different per county, but all the surrounding Austin counties is what I just gave you. So at the end of the day, somebody with a 640 credit score that's doing it on their own is going to have like a 5.5% interest rate or something. I mean,
Right. Yeah.
not going to be a 3.125. I guarantee it.
Right.
Comes with reduced mortgage insurance too, and you can combine that FCC credit I talked about and get that tax refund at the end of the year.
That's friggin' awesome. That's
Right now is it's a weird time. I get like 800 credit score borrowers come to me, and they get a better deal using the down payment assistance program than they do doing it on their own.
And I'm gonna pause you for a second. Shelly was the one I asked you the original question for. Answer her in 2 words, or 3 words, or 5 words.
Steven, just start over. Tell me, do I close my credit card or leave it open? Does it hurt us? Don't ever close it. That's a great question. Don't ever close it. 35% of your credit score is tied into history. So most of the time, closing down a card hurts your score a lot. Don't ever close it. I mean, if you've, like I said earlier, if you got like a huge annual fee or something, okay, but it's going to hurt your score. Unless you've had a bunch of missed payments on that card, then in that case, please do. Get rid of that history.
And I'm gonna kind of get off on another little tangent here, and just hearing you kind of go through and talk about, hey, there's this program and there's all this stuff, and if you do this, and then if you do that, or if you're this way, or if you're that way, that guys, this is confusing as hell, and this is and it's the same in real estate with realtors. If you're using a professional that knows the answers to these questions, or like in Amy's case, if you've got a lender that's willing to actually go out of their way and learn it, then that's, you're working with the right person. But a lot of times, I'm going to badmouth online lenders right now.
I'm not legally allowed to, so you go right
I'm
ahead.
going to do it. I'm going to do it
I'll put that in mind.
because if you jump in with an online lender, guys, they have this little box like this. Well, it's not I can't make a box. Anyway, they've got this little box. And if you fit into that little box, everything is smooth, everything is great. If you start getting outside the box, if you color outside the lines, if you're self-employed, if you need credit repair, if you're looking for a specific type of down payment program, it's probably not going to be the best thing for you. Find somebody local like Steven that you can go and sit down with and talk to.
Yeah, I'd
And
love it to be me.
Yeah,
But
it doesn't have to be him.
Listen to him. He's right. Sorry. Yeah, keep going.
Yeah,
Sorry.
I mean, it's the same as me. You don't have to use me as a realtor. Go find somebody that you trust and that you like. I mean, a lot of people don't like me. Let me look at the shirt I'm wearing. Hell, I'm in Austin. A lot of people don't like me, and that's fine. But go find somebody that knows what the hell they're doing. and somebody that can protect you and actually knows how to deal with things that are outside of the box. It just, there you go. That's my tangent, I guess.
I'll take it. I'll take it. Now, you can't be the king of everything, right? You gotta be the king of a few things. Otherwise, you're the king of nothing.
That's right. That's right.
I
Hey,
really do specialize in first-time home buyers. Let's go.
no, Nick's got, and we touched on it a little bit earlier. Do you need to keep the balance on a credit card? Go ahead, hit it again because it's top of mind.
Yeah, so I have a program called a What If Simulator as a lender, and I am able to put in, or to basically look at all of your debts and your credit score, and then change how much money you have on the credit card in a what if kind of scenario, and to see what it would do to your score. And I got some people that are at very low credit scores, right? Like maybe 400 or 500 score. And I get in there and I'm like, okay, let's say they had $10,000 to spend and we paid off this credit card. And when I was first a lender, this was really what got me going, because I love these numbers. Even if the client didn't care about it, I could still run it. And so when I take like a $10,000 credit card that's almost maxed out and I pay the whole thing off, they get almost instantly, that next month, they get like 30 or 40 credit points. Okay. But if I were to leave a $10 balance on that card instead of paying it all the way off, just leave $10 on it, they get like a 70 credit score above. So the reality is you always want to leave a bit of something on the card, right? Like $10, something like that. I don't know if there's an exact science with how much you need to leave on it, but I'll tell you what the exact science is. They want you in enough pain to pay them, but not enough pain to be a threat to them. If you don't pay any interest, you're not making them any money. And credit scores, like I said earlier, is not made by some moral authority out there. It's made by a bunch of corporations trying to make some money, right? So they'll reward you for paying them, unfortunately.
Right.
Never, ever pay off a collection. I also said that, and keep all of your cards under a 30% utilization. So you got $1,000 limit, keep it at 300 or less.
And I'm gonna kind of go off on a tangent because there's a lot of people that watch my stuff that I know.
Wait.
Oh, go
And
ahead.
if you stop using a credit card, that's just fine. If you close it down, that's not. Sorry, that was the other part of that question.
Yep. Oh, and Shelly, that's what I was telling you yesterday. I thought for some reason in my head I was thinking it was either half or 2/3, but it's 1/3. So yeah, at half you start getting penalized.
Right.
If you
50%
over half your
utilization of the
utilization.
card, it hurts you. That's right.
Okay. And a lot of people, my wife and I are, I mean, you're going to laugh. We're Dave Ramsey advocates. Like, I like 85% of what he says.
I have the total money makeover on audio CD on Audible, right?
Yep.
Audio CD. How old am I? Go ahead.
It just makes sense. But this is that part where most people are, sorry, Dave, most people are not going to get to the point where they're paying cash for a house. So, this is how you learn to leverage and tweak things to your advantage. Now, again, overfixation, you get penalized. That's dumb.
Right.
And again, if you don't like me, you don't have to work with me. That's dumb. But learn how to tweak and manipulate the system for your benefit.
Yeah, Dave Ramsey has a lot of great stuff, and if you're in financial trouble, there's probably nobody better to listen to because he's pretty extreme and he'll get you out of trouble fast, right? But at the end of the day, some of the stuff he recommends, I as a numbers guy, I love math, right? And as a numbers guy, I'll tell you, when rates are as low as they are today, one of the things he says is to only get a 15-year mortgage. Okay, you're going to end up spending a lot of extra money every month. What if you were to spend that exact same amount of money and put it into something like the stock market, which historically is going to give you a much greater return than the 3% you're paying on your house? Now, if we're in 1983 and rates where they peaked at like 17.5% was the going rate, which meant the banks were really doing like 22.5% interest rates. Okay, you practically bought a home with a credit card back then, right? You paid that thing off as fast as you can.
That's right.
It looks fantastic compared to a 30-year, right?
That's right.
But when the rates are this cheap, minimum down, don't put a lot of money into your house, especially if we have another 2008. You know what I mean? And you buy, you pay for your home in cash, and now it's worth half the value overnight. You kidding me? You want to move now?
Yeah. Good luck. Don't call me.
Below the 10,
you'll hate
12
me.
years of money you just saved up with your sacrificing over the last decade and a half. I mean, no way. I'm sorry. Less is more. I do enjoy credit when it comes to this kind of thing, like buying a house. Yeah.
And Shelly's popping up here. You're not necessarily advocating keeping a third on your card, keeping some on your card. But if you're going to be buying a house in the next 3 or 4 months, is that when you want to have it higher?
What a wonderful question Nick just had. Is that what you were just asking me about, or what?
No, I'm asking about the one that's on the screen. We'll get with Nick.
Oh, just kidding. All right. I want to make sure I understand. Keep 1/3 on the card. No.
Not at all times.
Right. So here's how it works. If your card has more than 50% used up, will drop points every month. If your score has between 30 and 50, your score is stagnant. If it's under 30, your score is going up. So you want to keep the balance in your card under 1/3.
So $10 is fine.
Yeah. I don't know any credit cards that have like a $30 balance. You know what I mean? So
right. So you don't necessarily want to keep 1/3 on at all times. You just want to keep between 0 and 1/3.
Correct. Don't exceed 1/3 on the card, and always keep a tiny balance.
Gotcha. Okay. So, and then we'll jump over to Nick's. Is there a credit score at which you need to try to increase it anymore? Is there a difference between 8 and 810?
So, God, that's a great question. The only thing that credit score affects point for point is the mortgage insurance cost for conventional loans.
Okay.
Credit absolutely affects your interest rate, but it doesn't affect it based so much on the score as much as it is by the tier you're in. So, credit tiers come in scores of 20. So you start, like, let's just say we're 580, right? That used to be the old one. So you'd be at a 580 tier. And then, so if you're anywhere in between, 580 and 599, you're in that tier. As soon as you hit 600, boom, you're at the next tier up until 619. Okay. And then boom, the next tier is 620. And so every 20 points goes up and up and up. And that stops at 760. So in fact, it stops at 740 for most interest rates. Glad you got it. And it stops at 760 for everything else. So if you have a 760 credit score or an 850 credit score, you will get the same numbers no matter what.
There you go. And so, Nick, I guess you're talking about diminishing returns. Are you talking on the amount left on a credit card? I think that's what that's referring to.
Yeah, I'm not sure.
So basically, if you're above what number, does it not matter anymore? Did you just say 760? Like 760 and above, that's the best you can do. Is that what you just said?
I'm sorry, I'm reading Amy's.
I was going to pop that up here.
The best you can do. Yes, I love those.
Okay, so 760 and above. Okay, good deal. So let's pop Amy's score went down when I paid off my credit card, student loans, and my card. No debt. My score went down. So put authorized user on my mom's card. There you go. Amazing credit score went up. Same
so
thing.
There's a thing called installment. When you have different kind of debts, there's an installment loan and there's a revolving loan.
Right.
So the revolving is stuff that will just keep hitting you forever, like credit cards, right? As long as you use it, you get the card. It's revolving. The other ones are installment loans, right? So the same. You got 72 payments on your car to make, right? When those are gone, you're good. When you pay that whole thing off, it does nothing for your credit score. Believe it or not, only paying off credit cards really help the score. Now you can hurt your score with those loans, but you can't really help yourself very much with them. It's crazy the way they work, but because they're set for a set term, as opposed to a very long period of time over history fluctuating and kind of thing. They just don't throw it into the equation. It's crazy. I can get people to buy more house if I pay off a car, right? Because they don't have as many debts.
Yeah, your DTI changes here.
But it never, ever, ever has helped the credit score, ever, when I've done the simulators over 7.5 years.
That's crazy.
That's where it might help, but I've never seen it.
Right. And I was going to say on Amy's, my wife and I, when we built our house, we had our house in South Austin, and we sold it in May of that year because, the right time to sell. And we moved in with our in-laws, and we didn't have a house payment until February.
Sounds great.
And when we went to go, because my credit has always been right at 800. My wife's has always been right at 806. I say always. Once I got rid of all my college debt and my dumbassedness, my credit score went up. So we've always been, I've been at 800. She's been at like 806 or 811, whatever. And she fluctuates a little bit. We go to get our permanent financing, and my credit score is like 770, and I'm losing my mind. Like, what the hell happened? And it was still fine. We were in the top tier, but I lost my mind. I'm like, no, I've got an 800 credit score. What the hell? You paid off your house. When we sold our house, it paid it off. We didn't have that credit or debt anymore.
Yeah. So no, that's one example of an installment loan that is over 30 years in most cases, right? So in that case, that would affect the score.
Yeah.
But usually you're selling a home and buying a new one, so you replace the debt with a brand new one. It never hits it at all. Kind of crazy.
Gotcha. Shelly's got another one here, and this is actually she doesn't realize it, but this is a multi-part question. How much should be expected to save or put down on a house, not a first-time home buyer?
Yeah. So when you buy a home, there's three costs. You've got your down payment. Everybody knows about the down payment, right? Then you've got your closing costs. That's like paying me, okay, and other people down the road. And then you've got what's called prepaid items, which is really taxes and insurance, okay? That comes as a shock to a lot of people too. So
Yeah.
I would say this scales with the price of the home. So take this with a grain of salt, okay? But I would say that the average person will pay about $10,000 in closing costs.
Just closing costs.
Well, no, I'm sorry. Closing costs and prepaids.
Closing costs and prepaids.
So,
Okay.
so everything minus the down payment. Then throw on the down payment on top of that, and that's how much you need to buy the home. Now, that being said, that program I mentioned, you don't have to be a first-time home buyer. The one that gives you the 3% assistance at the 3.125 interest rate, or 2.875 UNFHA. Let's get back to FHA in a bit and talk about mortgage insurance, please. But yeah, you don't have to be a first-time home buyer to use that program, and you can take up to 5%, and your down payment would be anywhere between 3.5% and 5%. So in your case, you could do a 5% down payment, take the 5% assistance, and then you'd need about $10,000 to move in.
There you go. And that's why I was laughing, because people don't realize about the prepaids and the closing costs. Typically, what I do for closing costs is tell people around 3%, and that seems like it's pretty close to right 3.5%, depending on what time of the year.
Yeah, I wish I could use that. It's probably right 90% of the time, but when it's not,
It's
blows.
bad.
I have to be a little more specific with it, but that's pretty accurate actually. You're pretty close. I've heard a lot of realtors do that. That's pretty.
It's because our minds are small and we just have to stick on like rough numbers. I'll start using 3.5 to make sure that I'm covering. Amy, have a good day. No, that's awesome.
Yeah, man, I got in trouble last year because in Austin, it's almost always the same percentage for insurance, and I had somebody in Houston. God, I felt awful. It was like 5 times what I estimated.
Ooh.
You said using someone local. I learned that the hard way too, right? I mean, I'm not local in Houston. I'm local in Austin. I'd love,
Right.
But I did
And
not.
you can now. I want to
be higher there. I should have known. I mean, flood or whatever.
Yeah, flood and everything else. And I want to draw that distinction because you and I can both practice real estate and lending anywhere in the state of Texas.
Correct.
And I know a lot of agents and lenders that do, and a little bit different on the lender side. It's you don't have to necessarily know the market; you just have to know what the costs are and fees and stuff like that. But
yes.
I mean, I saw a house that was listed in Dripping Springs yesterday, and I hope nobody. I'm not going to use any names; it doesn't matter. Listed a house, beautiful home, $880,000, $875 something, and it was listed with a realtor out of Houston. Almost a $900,000 home, and there were 6 cell phone pictures on it. What are you doing? What the hell are you doing? Now, hopefully they were just waiting for professional photos to come in. Side story, why you would put it up on the MLS if you didn't have professional photos, because everybody that's going to see it is going to see it in the first 24 hours and you just screwed yourself.
That's like a car company showing you the skeleton of their car before they.
Yeah. What are you doing?
Yeah.
By the way, Denise is one of our local title reps. Denise is amazing.
She's right.
And she knows local knowledge is key.
Right.
Absolutely
really
amazing.
Yes.
Dude, we have been doing this for, go ahead.
I was gonna say, even if I were doing loans in like Michigan or something, or I could do them in Michigan, which I could get right, or anywhere in the United States, I wouldn't. I don't ethically think it's. Yeah.
I've got a niece that bought a house in San Antonio and I referred it out.
See, now I would be able to help with San Antonio, but now I've learned to call my insurance guy first and be like, hey, can you give me a quote first before I tell them what the insurance is going to be?
Exactly. But again, a little bit different for you as a lender than me as an agent, because again, I don't, hell, where they ended up buying a house, I thought it was the sticks and there's like 15 huge neighborhoods there. Doesn't make sense.
I know you want to wrap up, but one last thing I really wanted to talk about was the FHA loans and conventional loans. A lot has changed. Like a lot has changed in the last roughly 10 years. Okay. 2009, a lot of changes happened after the 2008 crash. Mm-hmm. One of the big changes was that prior to all of this craziness, if you did an FHA or a conventional loan, You put 20% down and there's no mortgage insurance. You're good, fine. If you didn't, then once you got to like 22% down naturally, then it would just drop off. Okay, so that's what most people still think. Problem is that 2008 happened, and then all the things changed. And now, if you get an FHA loan, 3.5% down payment, it's really low income kind of loan. It's really meant to help the little guy, right? At least that's what it originally was.
Yeah.
Now, if you put down your minimum on that one, you get to pay for mortgage insurance, not
Upfront mortgage insurance premium
down until you pay off the whole loan.
Yep.
If you get a 30-year FHA loan and you put less than 10% down, you have to pay for that mortgage insurance on every payment, including your very last payment where you're paying $200 of principal off and you're done. Mortgage insurance is not insurance on your home. That's called homeowners insurance. When your house burns down, we like that. We love homeowners insurance, right? Mortgage insurance is insurance on your mortgage, but who owns the mortgage, Chris?
Your lender or whoever bought it in the secondary market.
Right. So
MERS
it's literally
MERS owns it.
It's awful. It's literally an insurance policy that you're paying for so that your bank will be okay if you lose your job or something. Don't worry.
That's right. It protects them, not you.
What? Yeah. So conventional has been left alone. It's still 22% or 20% or 22% getting there. It goes away. With FHA, you have to put you have to put 10% or more down, and then when you do, it only lasts for 11 years. So,
okay.
And what you said earlier, the two loans,
yeah,
really better. But if you don't explain that part of it, now you know why.
Well, and then not only that, and I don't want to
obvious, Shelley.
Give yeah. Say it again for the people in the back.
Politicians got involved to help fix our problems, and then the lobbyists got involved, and it was kind of a bloodbath. I mean, the whole point is this is for lower income people, and now you've made it even worse for them. You're going to punish 30 years and not even give them options they had before. And what we're really doing is protecting the bank. So how get involved to help the little guy and then protect the big guy? I mean, it's just stupid. Politics. That's why it changed.
And so here's this.
I like helping people.
No, it's good, and that's the passion is obvious, and that's what we want to see.
I can be much, I know.
By the way, guys, Steve's a Midwest guy, so he's a little rough around the edges. He doesn't have that southern charm.
Get out. I got to get inside.
But one thing that I want to touch on that, and what a lot of people don't know is they're like, FHA loan is only 3.5% down, but also talk about the additional fee that what I was saying with my client a while ago that made the cost to close higher. Talk about the extra fee that you have to charge.
Yeah. So it's a really good call. So I just explained what mortgage insurance was, right? If you do a conventional loan and you don't put 20% down, you pretty much have to pay for a monthly cost of mortgage insurance. Asking the question one more time. I'm so sorry. I have so many things on my mind right now.
If you do an FHA loan, talk about the additional fee that you have to pay in order to
when
get that.
When you do the conventional loan, you just pay monthly and that's it. Thank you. I was going okay. And then
you have an option to pay it off up front also. You can do an upfront on
that's called a single premium. You can also do lender paid mortgage insurance where you got a slightly higher interest rate, but then the lender takes care of it for you by charging you more every month, right? It's really a little less than paying for it sometimes, but the details, right? But with FHA, it's not called a setup fee, but let's just be honest, setup fee. It's called a mortgage insurance premium setup fee, basically, right? And they charge you, I believe it's 1.75% of the loan amount, but they don't charge it to you directly. They put it into your loan, so you get to pay that over 30 years at whatever more interest rate you took.
And then you pay mortgage insurance on top of that
to
cover that.
And then they charge you every year for 30 years.
That's right. So if you've got 3.5% to put down and you're considering an FHA loan, basically there's a few times when you should do an FHA, but if you're going to put 3.5% down and then you're going to have to pay that 1.75, you're at 5% anyway. Find gift funds or something. Get to conventional.
Yeah, don't get me wrong. If you're renting and your only option is FHA, that is an awesome option. Way better than renting.
That's right.
It's better than owning your house. I mean, at least historically you can't, right? It's the best thing you'll ever invest in. So don't let an extra $100 a month or something like that stop you from doing it, because this is something you'll build up over time. It'll be something you can sell off, you can borrow from. Tax shelter. It's trust me, it's good.
There you go. Man, 50 minutes.
I thought you said you wanted like 15 minutes.
Well, I just said that we had to get past 10.
I love this. I love it. I mean, I've had so much fun with this. You can invite me anytime. Thank you for inviting me to this.
No,
thank
and
you
I think we need to kind of get this going on a little bit of a recurring thing, because there was a lot of good interaction and questions, and people want to know this stuff. Like you said, if you're not in it every day, you don't know. You don't even know what questions to ask.
Yeah, I love teaching more than anything. My goal this year is going, as of last week, actually, I just went to this big sales thing, is to try to get on YouTube and put out some videos that other people can see, so that I can teach them some of this stuff too. I really, really, really do want to help. I just don't really know the best way about going about it besides one-on-one with clients, So.
Yep. Yeah. And by the way, this was Shelly's original question. Yeah. So anyway, guys, we are going to get gone. It is 10:30 and I'm leaving in an hour and a half to College Station. We're going to go socially distance, watch some football today. I am fired up about that.
We're not social distancing at all. I've got my kid's birthday party today.
There you go. Just
only people in the neighborhood. So that's kind of.
Yeah, it's your own little pod.
All right. I do like to social distance, to be honest. It freaks me out, everything going on. But yeah, it's my kid's birthday. Sorry, it's turning 4 today. I gotta.
Right. It's a big deal. That's a big deal. But all right, guys. I think Steve and I are gonna end up. Maybe trying to make a little bit of a recurring theme on this, and maybe do these often. So at least if he wants to, because it's a lot of fun. If you've got additional questions on mortgages, Steve, give us your phone number. Actually, wait for a second. Let me get my banner. And no, that's not what I wanted. I want to know.
That's not my phone number. Don't call me at that number.
Don't call Steve at that number. I don't know who that is. Let me see. All right, Steve, what's your number?
512-497-3742. Call me, text me anytime. Honestly, I'd love to help, even if it's just a question. You don't have to be doing business with me to get an answer.
Yeah, that's everybody that knows me knows that. You don't have to pick me. Pick somebody that you like. But
yeah, if I really help you out a lot, if I really help you out a lot and you appreciate it, you can just send all your friends to me. That's fine.
That's right. Because all of your friends will love us, even if you don't.
Chris, thank you so much for this, and thank you everybody for watching.
Yep, and Stephen, I'm going to end the broadcast, and we can still.
Stick around.
Okay, just letting you know. All right, guys, have a good weekend.
Bye, everybody.